let's talk a little bit more about assets, liabilities, equity, and so on. So to give you a better understanding, most probably you have heard the term assets, liabilities, so you have a feeling what this means. But to put it properly as a definition, assets are things that a company owns. They are the company's property, and they are also called the company resources. Assets are recorded on balance sheet statement. This is an important thing to remember for you. Assets are part of the balance sheet, not a profit and loss. Okay? What are the examples of assets, company assets? So first of all, cash in bank. It's an asset, the company resources. Secondly, debtors. In other words, accounts receivable. So any money that is due to you, to the business from your customers. So you issued a sales invoice, they haven't paid yet, but the money is owed to you. So this is your asset. Secondly, fixed assets. I'm sure you have heard the term. Fixed assets have physical form, and they have longer useful life than 1 year. So this will be plant, machinery, equipment, vehicles, and so on. There are some more. For instance, computer equipment. Secondly, well, the next example is prepayments. So, for instance, you pay a subscription for a full year of using Zoom. So you will not book everything straight away into your profit and loss, into your costs. Some of it you will need to spread the cost over the year. So the part which relates to future periods will go to your prepayments. This is your asset. You haven't paid that yet. The next example is VAT receivable. So you are most certainly you are aware that if you are VAT registered, you are able to reclaim VAT on your purchases. And this VAT reclaimable is called also VAT receivable. And this is your asset. This is money due to you from the revenue. That's the next example. The final example is inventory and stock. If you are selling goods and you keep inventory in your warehouse, this is your asset. This is part of your balance sheet. This is the company resource. All right, let's move on to liabilities. What's the definition? Liabilities are obligations of the company. So these will be amounts owed to third parties like suppliers, like bank, for instance. So most probably that's quite intuitive to understand what a liability is. And they are also recorded on the balance sheet statement. They are also part of the balance sheet, not profit and loss account. Examples, as I mentioned, loans taken by the business. So you take a loan from the bank, you owe the money to the bank. That's your liability. So you will record it as a credit on a liability side. Secondly, creditors or accounts payable. So these are payments due to suppliers. You bought something, but you haven't paid for it yet because the supplier gave you 30 days for the payment, right? To make the payment. So you would record such invoice as accounts payable. So the money you owe to this supplier, a credit, a liability. Next good example is wages and salaries payable. Do not mix it with cost of salaries. Because when you owe the money, when you record the sales for your employees, first you will record the cost and you will record the liability on the other side. And for instance, you will make the payment, your payroll run is in 1 week, and then you will make the payment. So the money you owe to your employees, wages payable, will go as your liability. Next good example is accrued liabilities or accruals. Perhaps you heard the word. It's a very specific accounting term. So these will be money due to be paid in the future. So for instance, you are expecting to get an invoice, a big bill for annual rent, okay, but it hasn't been issued yet. So you are booking an accrual because you expect to make this payment in the future. So the liability already exists because you signed the contract with the landlord, but the invoice has not been issued yet. So you are booking an accrual for a future payment. Next one is VAT payable, the opposite of VAT receivable. When you are VAT registered, you have to charge VAT on your sales. And this VAT you need to pay to the revenue. So this is your liability, your VAT payable, and it will go as a credit on your balance sheet. Okay? Any other taxes like income tax and corporation tax payable that you need to pay, not receive, will be your liability as well, and they will be recorded as a credit on the balance sheet. What is equity? It is more difficult maybe to understand for some of you who don't have any accounting background or bookkeeping background or training. So I'll try to explain it in simple words. So equity relates, first of all, it relates more to companies and corporations. For sole traders, it is usually called owner's equity. And this would be shareholders or owners' investment in the company. So the money that you invested to start the business, or you injected the cash, for instance, to buy something. So this can go as an equity. There are some specific cases that it can be treated differently, but I will not go into that during this basic session. In other words, we can also call the equity the difference between assets and liabilities. Remember the fundamental accounting equation. Assets have to equal liabilities and equity. So simply the equity will be the difference between the two to make the balance sheet balance. Also, one important thing to keep in mind that equity will also include your so-called retained earnings. So these are profits from prior years. It will go to your equity as well. And as already mentioned, equity is part of the balance sheet statement, of course.